Investing can be confusing. Should you put your money in index funds or pick your own individual stocks? Which strategy builds more wealth? Which one is safer? By the end of this video, you'll know exactly which one is right for you. Let's break it down. What is an index fund? An index fund is a collection of stocks that tracks a market index like the S&P 500, which includes 500 of the biggest US companies, and the NASDAQ 100, focused on tech giants like Apple and Microsoft. The total stock market index, covering almost every US stock. When you invest in an index fund, you're buying a little piece of hundreds of companies at once. Instead of betting on one company, you're betting on the entire market. And history shows that markets go up over time. Pros of index funds: diversification. Your risk is spread across many companies. Lower risk. If one company fails, you still have hundreds of others. Low fees. No expensive management costs. Set it and forget it. A great option for long-term investors. But index funds aren't the only option. What is an individual stock? An individual stock is just one company, like Tesla, Amazon, or Google. If the company performs well, your investment can skyrocket. But if it fails, you can lose a lot fast. Pros of individual stocks: higher potential returns. If you pick the right stock, gains can be huge. More control. You decide what to buy and sell. Dividends. Some companies pay you just for holding their stock. Cons of individual stocks: higher risk. If a company struggles, your investment can drop quickly. More research needed. You need to study financials, trends, and company leadership. Emotional investing. Stock prices go up and down daily, and it's easy to panic sell. Which one makes more money? Historically, index funds outperform most stock pickers over the long term. Why? Because they include the best performing companies automatically. They remove emotional decisions from investing. Over 90% of professional investors fail to beat the market. That's why Warren Buffett recommends index funds for most investors. However, individual stocks can make you more money if you pick the right ones. For example, $1,000 invested in Amazon in 2001 would be worth over $1 million today. But for every Amazon, there are hundreds of companies that fail. Which one is right for you? Choose index funds if you want low risk and steady long-term growth. You don't have time to research stocks. You prefer a hands-off investment strategy. Choose individual stocks if you enjoy researching companies and tracking the stock market. You can handle risk and short-term losses. You want the potential for higher returns. The best strategy? Most smart investors do both. 80-90% in index funds for safe long-term growth. 10-20% in individual stocks for higher risk opportunities. This gives you steady growth while still allowing some high-reward investments. Final thoughts. Which one is best for you? Index funds are safe, simple, and powerful for building long-term wealth. Individual stocks offer higher potential returns, but with more risk. What do you think? Are you an index fund investor, or do you prefer picking stocks? Let me know in the comments. Don't forget to like and subscribe for more investing tips.